Good morning, everybody. It's Monday, November 13th, and this is the AgYield War Room. My name is Dan Dempsey, and I'll be moderating today's session. Quick update on the overnight markets. Corn was down $0.01 3/4, 462 1/4 for the December contract. January beans were up 7.5 at 13.55, and December Chicago wheat was down 3 3/4 at 571.5. Before we begin, if anybody has any comments or thoughts, please leave those in the chat section, and we'll be sure to address those as we're going through the War Room session here this morning. A couple of announcements this morning also in the way of 204,000 soybeans to China for 23 and 143,000 corn delivered to Mexico for 23 as well. As we begin this morning, guys, I noticed just a brief highlight that Brazilian farmers were about 12% or so behind planting from last year. And I know, Dustin, you had a couple of points you wanted to make on that as we started this morning. I think you're muted there, Dust.
Yeah, thanks, Dan. Sorry about that. Yeah, so we continue to see on social media that we are hearing a lot of excitement about what could happen with the delay in plantings for Brazil, the potential production problems that could come from that. We are seeing, the ratio between soybeans to corn, which is what we're looking at now, at its highest point yet this year. So at no other time has beans been more valuable to corn than right now. And so that a lot of that is built into the market. So the question is, what are beans capable of doing from this weather event down in South America? We want to remind everyone it's still pretty early in the year. It's like getting excited in May for the rally, and it may very well continue to trend this way and be a big blow up year for beans. But there's still time for the year left. And looking at this ratio, looking at the ratio 2.93 to 1, close to 3 to 1, that's a very high ratio of beans to corn. So that shows a lot of that strength is being built into that bean crop, and this is carrying on to multiple crop years as well. 24 beans are slightly elevated to 24 corn. So what do we do about that? Just an acknowledgement more than anything that at this point the ratio can do whatever it wants to do. U.S. corn still looks fairly abundant. That might also partly be why this ratio is very high. And corn is capable of testing down into the 450s today. It's very close to that. We're at new contract lows overnight. So we'll have to see how the day session goes.
Very good. We got a question that's come in from one of our growers here. We've seen a surge in the last couple of weeks of deliveries out of over in the Black Sea. And are we starting to lose some of that as a news headline, guys, or how's that relating back into our markets as we're going forward here?
I'll jump in there. I think we've seen a muted response to problems over there. With the last one that was material was back in mid-July. We did see a kind of a run up last week in wheat when a vessel was struck there by I think a mine in the sea, but we haven't been able to hold any water on those types of rallies. So I do think it has become very much a muted response in our markets, and it's been showing that as repeated events don't have any sustainability in our markets.
Yeah, that's good stuff, Ben. One other thing to note, this week we've got President Biden meeting with President Xi for the first, it'll be Xi's first trip to the United States in 6 years. With everything obviously going on geopolitically right now, is the markets, certainly going to take a look at what comes out of those headlines and how we progress there.
Yeah, I would say, today we got some sales, obviously, to China already, 204,000 metric tons of beans. China has not been a buyer of first resort from the U.S. That we really have not seen any corn sales. They are still going to buy the cheapest that they can buy. and whether that be South America or the US. So I think free markets still prevail at the moment. But obviously the relationship still seems a little cold, and there's a big question over Taiwan over the next couple of years. So I think geopolitics is more like the elephant in the room of the ultimate risk, just like we had in 2018, is we have to be mindful that at any moment, if that starts to sour worse, that things can drop off for non-free market reasons. The trade war really caught a lot of people by surprise. Beans, fell from well above $10 down to the mid eights in 2018 during that trade war. We still have these tariffs in place, so it's definitely not something to disregard. I would say that watching for headlines and just being more mindful of that ultimate risk. If those relations start to sour, the market will see that as a negative.
Yeah, and I think too, just to add to that, you talked about Black Sea at first and some of these geopolitical tensions. At the end of the day, it's got to turn into sales to the U.S. So I think when we first started with the Ukraine-Russia war, we ran prices up extremely high. It never, materialized into meaningful sales to the U.S. And Ukraine, that area was able to get more and more grain out than we thought. Same with China. We always speculate on what China's going to do, but at the end of the day, it's how much they actually take. I think to Dustin, to your point, we're still on a kind of a sour note here with China, obviously. We may see some goodwill purchases by them going into these meetings. So it wouldn't surprise me to see some big, another big kind of frame contract or something that the headlines really grab onto like today or tomorrow. But at the end of the day, I think that's just more of a PR stunt, at least for now. Like you said, it could always materialize. We could stay in a dry pattern in South America for the next 3 or 4 months. Like, obviously, that's going to have a big impact on the markets. But to your point, it's like getting excited in May, right? And I think when you have these big run-ups and if it stays in a dry pattern for 3 or 4 weeks and, beans rally $1, $1.50, whatever that may be, at the end of the day, the grower still needs to look at what that means to the farm, right? What kind of opportunities does that provide for old crop beans, for the 24 soybeans, as that ratio in 24 goes up, and anhydrous prices and input prices have started coming up again, we should see a natural shift, and we've talked about this in the letter, back to soybean acres, right? So as that ratio gets above 2.6 in the 24 contracts, that's kind of where we see a huge signal to switch to a lot more acres. And say that pushes 2.6, 2.7, 2.8. I'd be really mindful of making really good sales at those levels in soybeans potentially here, especially if it happens in the next, month or so.
So we got a question coming in from a grower here relative to the December of 24 corn contract. Now that it's back above $5, obviously, it's going to be different for everybody, but this particular grower wonders, will they see another opportunity to trade 550 again in December 24?
It's a tough one. Never say never, that's for sure. And we were just, pushing on 520, and that's, last week, I think. So, I think if there is bullishness in the corn market, it's in the July and forward contracts. I think as you look at potentially, switching acres to more soybeans, depends how South America pans out. Obviously, their big crop's the safrinha crop, so when people get excited about corn right now because it's dry, I think it's kind of a moot point. I mean, it's really the second crop that they plant behind soybeans that's the big crop there. So any kind of issues that you see, probably, March, Jan, that time frame, I think would give you the best chance of seeing that July 24 through D's 24 contracts go up, in my opinion. So I'd say yes, I do think there's a chance we have to have a South American problem, and we have to see demand start to pick up. Right now I think you've got so much pressure on the nearby contracts because crops are bigger than most people anticipated. Farmers relatively unsold compared to normal. And storage is filling up. Interest rates are high. A lot of things that we've already talked about. So you've got a lot of near-term heaviness on corn. If there's any bullishness, I think it is in the back contracts.
Very good. Ben, on your side, are we making progress in the Eastern Belt? I know that harvest has been kind of a slow trudge a little bit for some guys, but are you starting to see guys going?
Yeah, we're heavily into corn at this point. Corn basis has dropped. It's 45 to 50 under in a lot of places, filling up, reduced hours. Rail's not performing to the degree that they need to. A lot of destinations are going to limited hours. When this happens in the Eastern Corn Belt, they're relegated to letting the processor dig them out, and that comes at a much lower pace. Southwest Ohio, 100-mile radius of Greenville, Ohio, goes through about 1 million bushels of corn a day. That's essentially 3 trains. So if trains aren't performing, they have to rely on that. And we've seen basis drop off, really big crop. Guys that can typically store all their crop plus a little bit are running out of space. So it certainly is, we're at that point now where it's plugged.
Very good. Got a couple minutes left here this morning. Ryland, first highlight. I mean, cattle's starting to develop some sort of stability here. What's your thoughts as we head into the week?
Yeah. So last week, Dan, we lost $9, about 5% off the live cattle futures. So, and we got another cattle on feed report coming up on Friday. So we'll see what the general consensus is. I think right now the market's a little bit scared that the upfront supply is going to be pretty heavy as we look into November 1 on feed inventory. I think already the calls for at least steady, if not about a 2% increase. So we're seeing these numbers really start to show up in the front end of the market. And as we talked about last week, it still could be that we're seeing a little bit of a ramp up in these imports from other countries of cattle, whether it be Canada, Mexico. But we'll know more once we kind of see the data. Beef market started to back off as well. Cash was also down. So the trend is pretty negative going into this week, and we're pretty oversold. So hopefully we can find some support here, get some opportunity to market a little bit more here for the guys that kind of may need to get some sales on. Overall, it seems like once the cattle market kind of picks a direction or a trend into the end of the year, there could be a lot of headwinds, especially like in the hogs. Cash and pork prices tend to trend lower seasonally from here on out. We're past the grilling season window, and now we're starting to look at holiday demand and really start to scrutinize that. And right now, all the focus is going to be on turkey for the features. So we don't think we're going to get a whole lot of demand here from the consumer to support beef. But you price in a lot of bad news this week. I'm looking for a little bit more stability here.
Very good. Thank you, Ron. Couple minutes to the open here, guys. Just some final thoughts. As we head into another week, I know we're gonna following week is gonna be Thanksgiving, which tends to be an interesting week going into option expiration. But just any thoughts as we start off here?
I did want to touch on one thing because I think DS24 is on a lot of people's minds right now, and we're just starting to get a better understanding of where all costs are coming in. Preliminary numbers came in; they were still coming in pretty high. This cost reduction inflation has been fairly sticky. So land rents have been very high still. Interest rates have stayed very elevated, especially for those that are coming out of locked rates. And so we're seeing a lot of break even still at the 520 to 530 price point for cash corn for DS24. So, we can get there if we have a slightly above average yield and are able to collect decent basis and decent carry, get to profitability that's reasonable. But that's if we sell everything right now. So I think that's maybe our best chance for keeping corn prices supported is the fact that producer selling, as we become more aware as a nation, that's still going to cost us quite a bit to grow next year. Now, that being said, I think your biggest risk is still going to be the discovery that if this crop size continues to grow into the Jan reports and our demand doesn't start to increase, right? We've written down some lofty numbers in the USDA balance sheets. We might go into next year with a 2.4, 2.5, 2.6 billion bushel carry in to the 24 growing season. we might not need as many corn acres. It could easily be 89 million acres of both corn and beans next year, in my opinion. And so, does the market need to provide profitability? No, not necessarily. Does it often provide a chance to be profitable at some point early in the season? Yes. I think for us, that just is going to make us be extremely on point, trying to cross all those T's and make sure that we've got a good plan B in place. And then we're not, taking a north of $5 price for granted as we go into, JFM, especially as we go into April and May. We've got to make some harder decisions if we haven't seen a bigger rally by then.
Yeah, and Dustin, to that point, that's why the trades that we have been recommending, are trades that could work into a 550, 560, 570 sale, early in the year, right? So some of those types of trades we're doing, I think are ways to try to lock those in if we see that kind of seasonal time to get those for the D's 24 contract. So, I'm going to, talk to your advisor if you want to, refresh all that, but that's, really what I think we're looking at is if you get a chance between now and March where you can get something 550 or above, probably going to be a good way to lock some in.
As we thank you, Justin. And one last question here as we roll. Over the years, traders have said that Thanksgiving weeks gives a glimpse of the rest of the year's trading direction. Barring something crazy happening, do you agree with that old trader's adage?
Oh, it's hard to tell these days. Thanksgiving a lot of times is a turning point, especially in bear markets. We talked about it's kind of going into first notice day of the December contract. I think we've been kind of had some bearish corn spreads on and things of that nature. We've been advising for people that have extra stuff they need to roll between now and the next week or week and a half. It's probably going to be a good window to make sure you're getting that done. Certainly between now and first notice day. I think that will happen. I think there's a good chance we put in some kind of a seasonal low between now and first notice day. That can always fail. If it's a really bearish scenario, obviously we can continue lower. But I would say, how we head into first notice day, a lot of times is a fade. So if we continue to break corn, all the way into December first notice day, usually it's a time to, kind of just step back for a second from hedging and or, re-own some stuff with calls if you feel like you have to. But yeah, to that question, it's holiday markets, right? So it gets really tricky as we get into kind of thinner markets. Hedge fund traders that have good profits are kind of trying to get out, not give the year back. So it can create a lot of volatility, a lot of thin markets as well, which can also create opportunity. So you could have a, end of the year rally, some kind of situation like that for sure.
Very good. We have opened here this morning. Just a quick update on the markets. December corn's unchanged at 464. January beans are up 8 1/4 at 13.55.5, and Chicago wheat's pretty much down about 3 across the board. As always, we look forward to talking to everybody this week. If you have any questions, your consultants are available. More than happy to go through AgYield, make sure that you've got everything positioned the proper way that you'd like. And thank you all for the questions here this morning. The feedback's great. And we will certainly look forward to talking to everybody tomorrow morning.
All right, thanks.
Thanks, Dan.
Thanks, Dan.